around. So, okay, we'll get started. Good afternoon, everyone. Thank you so much for your time today. Very happy that you have decided to join us. Today's panel, we have two ongoing sessions today. So the first is actually a panel session where we will launch our subcommittee for the security token. And following on that, it will be a panel discussion on security tokens. After that, we have Nizam hosting us for the RMO consultation paper. Okay, so I intend to make full use of today's session as a very candid and intimate session. So as and when you want to chime in or speak up, you can do so by raising your hands, and then our friend who's controlling the the ME panel will let you speak. Okay, so without further ado, let me just very quickly introduce the panelists. So first up, we have Chia Ling. Chia Ling is the managing director of the law firm OC Queen Street. Chia Ling is also an early enthusiast of blockchain and crypto tokens. So in 2014, he appeared in CNA to discuss the legal nature of Bitcoin. In 2015, he presented at a seminar at SMU on the rise of Bitcoin. 2017, he updated at SMU on ICOs, e-money and virtual currencies. In 2018, he flew to Berkeley Law School to attend a training session on different aspects of blockchains, right? And to date, the Singapore office has provided legal support to a number of exchanges and also a number of token projects ranging from utilities to payments to securities. Okay. Next up, we have Rahul. Rahul is the CEO and founder for Bonnie Value. It is an exchange that was approved to be in the FinTech Express sandbox, and subsequently, Bonnie Value exited with a full license. And in fact, Bonnie Value offers digital bonds on the blockchain. Okay. Next, we have Tuina. In a career spanning of 16 years, Tuina has made markets for institutional investors in several asset classes. She has set up derivatives trading desk for a private bank, successfully led the implementation of Calypso for bank treasury before becoming an active participant in the crypto space. She graduated with a computer engineering degree and an MBA from premier schools. Tuina is the CEO and co-founder for Propine, an MAS regulated custodian for digital assets, and it is backed by well-regarded institutional investors. Next, we have Heslin. Heslin is the Chief Growth Officer for DXX Asia and also partner at Digital Strategies Private Equity. He has over 11 years of experience in various industry roles and engagement within the DLT sector. Heslin's key strengths have culminated in his full engagement in accelerating the global tokenization of securities. He's also a well-known key opinion leader across Southeast Asia and Asia Pacific, and he has spoken in many conferences in championing tokenized digital securities. Right? He has also worked with funds and partners that has aggregated over 27 billion USD in tokenized assets. Last but not least, we have Glenn. Glenn is the managing director and head for APAC for Ledger. I think all of us know who Ledger is. So Glenn joined Ledger in October 2018. He is responsible for overseeing all Ledger's businesses in Asia-Pac. He has an extensive career in financial services and fintech. Previously, he worked for S&P, heading North Asia for 9 years, and prior to that, he was with Shinhan Financial Group in Korea as a consultant in asset custody and funds administration, right? And also myself, I'm representing ECXX. We, similar to the story for Propine and Bonnie Value, we are in the MES sandbox, and we are currently working with MES, and also offer a digital asset security exchange. So that's your panelists. So like I mentioned, today we are going to talk about security tokens. If you have any questions, please raise your hand. We will come to you. Okay. So without further ado, let me just move straight into the panel, and may I invite all the panelists to turn on your camera. So the panelists are also part of the security token subcommittee, and we deliberated quite a fair bit on the actual name for the subcommittee, because and in fact we will talk about this in a bit. You know, is it security tokens? Is it tokenized securities? Or, you know, some people, you know, take it as security token offerings and things like that. But we are calling it a security token subcommittee at this moment. And our role basically is to represent digital asset exchanges and also, you know, service providers in the tokenized securities space in speaking to the regulators, and also presenting a view where we can actually take this, you know, digital asset space further. Okay, so the companies that have made up of the subcommittee right now, they are, as of on your screen, PwC, okay, Bonnie Value, Ledger, Propine, OC Queen Street, DSX Asia, and of course ECXX. We welcome, if you are interested to join, please drop us a note or approach any of the subcommittee members after this. Okay. So, panelists, can you turn on your camera and your microphone? Yeah. Okay, so maybe I'll just start off with a very simple question. Perhaps you can tell us how you get involved in this security token space. Maybe we'll start off with Chia Ling.
Oh, I thought that was quite apparent in the introduction that you gave me already. Maybe we see what we can add on to. I think the firm Singapore office is one of the among the pioneers in getting into this space when the ICO craze started in 2016 in Singapore, right? 2017, 2018, then the ICO craze went down, then there's STO, and every now and then there are still projects ongoing. So since 2006, you know, activities increased, so the legal support from us as well increased. But of course, before that, there were pockets of special interest groups, people who are really interested in this area. And so I was also quite involved, and also those innovators were also trying to get into this, the cryptocurrency and security token space, even at that time. So in that sense, security tokens and non-security tokens, in that sense, it's not new in that sense. Yeah, thank you.
Okay, we can now maybe Rahul, you want to share how you got into the space?
Sure. You know, Branson, I spent most of my life in the bond market, and you know, the bond market has grown in Asia from about $7 billion when I joined 20 years ago to about $350 billion now. But what hasn't changed is it's still transacted on the phone. It's still done the old style. So that's why about 5 years ago, when I left Standard Chartered as their global head of corporate sales to start Bondi Value, so that was my first sort of entry into this. I did that MIT FinTech course in the first batch with some of you. So, you know, I think it all goes back to that, you know, exciting and formative period about 5 years ago.
Nice. Tuina?
Sure. So my entry into the space was a tiny bit accidental. I always think it was because of my son. So I took a break to start my family, and that gave me time to actually step back from day-to-day trading and market making activities. And I went back to you know, learning the new technologies out there. So I have a computer science background, always been coding. And as a part of that entire time when I was exploring the new technologies, I came across Bitcoin, which I had seen earlier in 2011, but this time, 2015, I was looking at it from a tech point of view, and I coded a little bit of rudimentary blockchain explorer, a little bit of wallet space, and I realized that, dude, this is a serious technology and it can have a massive impact on the capital markets. So that's when I decided that I don't want to go back to traditional banking space, and I want to stay in the fintech space. And I started out my foray into the space by getting involved in the Singapore crypto space, and I worked with a lot of companies on the ground in 2017 to be able to see what's really happening out here. And I very quickly realized that the whole idea that institutions are going to enter the space or support the space is not going to happen without a regulated, compliant infrastructure in place. And at that time, I had raised this conversation with a lot of people that I was working for, but none of them thought it was palatable to go for regulated infrastructure at that time. It was very unfashionable to get regulations in the crypto space. So I decided that I'll need to do this alone. And that's how the idea of Propind was born in 2017. And then the rest is history.
Very nice. Next up, we have Heslin. Heslin is no stranger to the security space. Heslin?
Sure. So I was involved quite heavily in Korea since 2010 in various consulting roles with corporations such as LGU+, Olay, Samsung Ventures. And when the cryptocurrency blockchain scene started to really gain momentum in 2017, I had initially started a marketing firm geared towards expansion of blockchain companies into Korea and Asia Pacific. And I started working with the company Polymath at the time, who was one of the pioneers in the security token space. Also, Digital Strategies, our PE fund, helped co-found that and further escalate the business. And through working with Polymath in the origination of the concept and quote unquote labeling of security tokens at the time, really garnered a lot of network in the space and a lot of forefront runners who were exploring this topic in DLT and blockchain and tokenized assets and the variety of different applications. I was in talks with many of them at the time. So saw a lot of the R&D and proof of concepts that were being explored 3 years ago, and have really watched the space evolve very, very specifically honed into the security token digital asset market over the last 3 years. In doing so, I moved over to another company called Tokeny Solutions, which was backed by Euronext Markets Singapore. And I was there for the past year. Our client, DSX Asia, acquired the exclusive licensing to Tokeny Solutions out of Asia Pacific. Also focused on a number of other verticals related to domestically licensed exchanges, a virtual investment bank, alternative lending platforms, e-wealth management platforms for distribution, a number of other companies that we've also invested, acquired, or JV'd into. And so been involved in the space for roughly 3.5 years, namely focused on the blockchain sector, DLT applications, and then seeing how that can be merged into the traditional capital markets. So happy to sit on a panel with players like Rahul and Tahina and Glenn, who have more extensive background in the capital market space, coming from the tech angle and security token application. So happy to be here. Thanks for inviting me, Branson.
Thanks, Heslin. Glenn?
Hello. Yeah, I'm Glenn. I'm the managing director of Ledger, Ledger Asia. I joined Ledger about 2 years ago. And of course, everybody knows Ledger as with this hardware wallet business. We're the largest when it comes to Ledger Nanos, but I joined the company to support their B2B value proposition, which is called Ledger Vault, which is an institutional custody technology that we currently work with crypto native players, but also with the banks and trustees and custodians that wants to come into the crypto space or digital asset space as a whole. So I was very excited to join Ledger to be part of the ecosystem building. So Ledger is building or will become one of the very strong infrastructure, one of the core missing piece since we've been kind of discussing this for close to 2 years now, that we're building these institutional capabilities where our solution can probably bring some streamline of the operational process that the traditional institutions have, so that they don't really have to reinvent the wheel. And when it comes to building and buy kind of decision, then they can partner with someone like Ledger to support the core infrastructure for wallet management, whether it's for crypto or for tokenized assets or security tokens. Ledger Nano is actually not so irrelevant, because I see a lot of STOs that are actually held on Ledger Nanos from an institutional perspective, but also certain STOs are kind of handheld. Self-custody is also possible as well. And from a technology perspective, from a security technology perspective, we're actually agnostic to what the actual coins or tokens are backing. So we will always provide the highest level of security for whoever that uses our product, whether it's retail or institutional. For tokenized assets or security tokens, I think the difference will lie on the features. So how would these core infrastructures, from a technology perspective, will support the life cycle of a security, minting or issuance or burning or redemption, things like dividend payment and so on and so forth, will be supported with the different features that we're going to put on our institutional product. So happy to be part of the ecosystem. And currently, as I said, we're enabling these traditional institutions to join the digital asset space. Thank you. Thanks,
Glenn. So I think for the second question, and in fact, just for the participants, I think we have seen a few questions, so we'll pick it up as we go along. So the second question to the panelists would be, where do you see the security token space heading towards? And of course, there are talks about security tokens versus tokenized securities. And what are your thoughts around that? And specific to Glenn, if you can answer this question, are there any so-called collaborations with the local banks, between Ledger and local banks? Yeah. So anyone would like to take this on initially?
Maybe I can kickstart the idea of the security tokens and tokenized securities. Doesn't seem to me at the moment terms of art, and probably we try not to look at them like terms of art and try to define them, rather perhaps to maybe find out by description their features, and to see to what extent they are really simplistic representations, or whether the distinction is meaningful or not. So, but still it's a starting point. I suspect that the distinction then will converge over time. So a token like the Bitcoin, we consider a digital asset. A token like a stable coin, perhaps also a digital asset. So if the digital asset is, because of its features, amount to securities, then it is a security token. So by contrast, say shares, if represented by a token, then it is a digitalized asset, as opposed to the digital asset, a digitalized asset. And if this digitalized asset is a security, then it's a tokenized security. Or rather, this digitalized asset is a tokenized security. But of course, in our universe, the question is whether these two classifications represent the entire universe of whatever we are talking about, right? Then we might consider things like a digital payment token derivative, whether they fall outside this concept, because it is conceivable they are neither securities nor tokens, in which case they fall outside these two categories. So where the distinction matters, security tokens and tokenized securities, we perhaps should look at whether there is any difference in terms of risks, right? Because there there's a distinction in terms of risk, then the regulation should be different. So stablecoins, they're tokens, but are they as well securities? And if they are, then they are security tokens. Still, if they also satisfy the digital payment token definition under the PS Act, then we will regulate them under the PS Act. But of course, the exception is when dealt with by, say, authorized exchanges or RMOs, in which case regulated as securities. So where the distinction does not matter, for example, and we all know there is this proposed regulation called the proposed Omnibus Act, and that includes a definition of a digital token, which goes something like this: a digital representation of a capital markets product. And by this definition, it no longer matters for the purposes of the Act whether you are dealing in security tokens or tokenized securities, because both will fall within this definition. Thanks.
I see. Wow, that's very extensive. Anyone else want to chime in? So can I summarize, Chia-Ling, what you just said is that it depends on the nature of the token, and therefore, it's not so much of tokenized securities or security tokens, but what the token itself, the features of the tokens, I would say. Is that right?
You can say that to a large extent, yes.
Right. Any other panelists would like to chime in?
Sure. I think I'd like to bring up a little bit about what the panel discussion is going to discuss later as well, which is about the RMO discussions and license exchanges in the region. So I think that plays into a very large part of where security tokens are headed in the future. And what we've seen over the last 3 years with incumbents who have tried to partake in the space. So if we look at exchanges like Open Finance, which is one of the first out of the US to go live, they had about 12 tokens trading, very minimal volume, very low liquidity, and not so much interest from investors for picking up these various types of assets. They're very focused on equity positions. And I think the type of asset, the investor base that you're targeting, and the demographic of different regions that you're also going to be dialing in on, play very much into a part of the success of the security token. It's not necessarily the industry as a whole that's going to move forward without significant assets that would already be very much of interest to high net worth, ultra net worth, the brokerage firms to pick up these assets, both to invest into, and then also the market makers to get involved with, to take on the risks, to provide that liquidity. So, I think it's first and foremost going to be about the types of assets that are going to be tokenized in the future, getting the investor interest garnered around that, a network effect of trust and security with this type of ecosystem and this type of technology. And then also the adoption from the regulatory front of moving forward to encompass all of this. So over the last 3 years, we've seen successes and failures, mostly failures, but it's necessary in a nascent space like this to have trial and error, to see where different firms have failed, different security tokens and security token offerings have failed, and learn from that. And I think that's really what's been going on, especially when you talk to any of the regional banks or exchanges who've all been watching what's been going on. NASDAQ had their original POCs for Link, one of their first blockchain initiatives dating back to 2015. So, same with ASX and their chess protocol. And we're seeing players like Hong Kong Stock Exchange enable their post-trade settlement processes now with Synapse, connecting various exchanges in the region. So I think when you look at where security tokens are headed in the future, none of us can predict what's going to happen. It's like picking up your first rotary phone and then expecting in 30, 40 years from now that you'll have a touch screen phone where you can do FaceTime with a person, immediately across the world. No one can expect really where the things are headed to that nature. But once we see further adoption and these regulations dialed in, it will give people the ability to test more and more these specific types of applications, and happy to hear where we're going to move forward with this RMO consultation paper in the next half of the discussion.
Yeah, thanks, Haslin. Of course, we all know that there are certain regional banks who have, I guess, prematurely announced their entry into the space as well. So, what are your thoughts as well, Rahul or Tuina, with regard to how this security tokens industry is headed towards?
Sure. Shall I take that, Rahul? Is that okay with
Sure,
you?
of course, absolutely.
Thank you. So I think I'll build on what Heslin's already said. Last 3 years have obviously seen quite a few projects with an immense number of failures. However, what is very interesting is I was part of some of these workshop sessions with the World Economic Forum over the last 3-4 weeks. And pretty much every large institution was a part of it, including NASDAQ, and Rahul's project and their POC was discussed in that as well.
Really?
What was really interesting was that not a single institution out there, they are all traditional institutions, not a single one of them was discussing whether or not security tokens, whether or not DLT. The question that was being discussed is that this is an inevitable future. What are the models that can potentially be adopted within the space? How will these models affect the processes in the capital markets, and how will it impact the role of various participants? So that itself shows that the crux of the capital markets, all the players are pretty much geared that that's the future. And the only discussion is to what extent will each player start to act, whether they will take on a full role and they will start to have a model which is end-to-end, like in the case of SIX from Switzerland, in case of SDX, or are they going to take on a model which is more focused only on the clearing and settlement side, the back office operations alone, which is the kind of model that's been adopted by ASX in Australia. Or you can say there's a third model that is being tried out by Paxos, which is like, we're going to create a parallel rail along with the existing rails. So, and another best part is that everyone knows that eventually everyone has to move towards an SDX type of model, where it is going to be an end-to-end tokenized version, right? A DLT version of capital markets. So I think that pretty much summarizes that this is an inevitable march towards that space. Everyone will move towards that future at their own varying speeds. So I think $1 trillion from that perspective is a very small figure.
Interesting. Rahul?
Over to you.
Sure, thanks. And Tuina, I need to buy you coffee to figure out what you were talking. I want to give a different perspective on this, okay? Securities laws are very, very important, and they've been around, and, we have to make sure that it is only when investors feel that the security tokens, any security market is properly organized, that there are safeguards, that excesses or, arbitrage of information will not happen, is when the industry will grow, right? So to me, that emphasis is most important. And the more mainstream we can become, the more we can as an industry show that we are properly regulated, that we have proper governance, that we do not allow anything that a good security market does not allow: insider trading, front running, that we have mechanisms for supervision, market surveillance. So I think, as Tuina and everyone says, yes, it will happen. And when it's not happening, the real issue is that there is no trust. So the more trust we make, the better the market will be. How does trust come? Trust comes from, and if you look at the recent Nobel Prize, it's on organized markets. Wherever markets get properly organized, that is where trust comes. So to me, that is the direction in which I see the industry going. And I also see it, if you imagine one of the big bridges in the world, how they build the big bridges, you go from both sides and they meet in the middle. So this security token offering will go from players from traditional securities who are going into this space, like Bondi Value, for example. There are also players who are going from the crypto, STO and coming into securities. And they will both meet in the middle, which is why we are seeing all this excitement. Now, if you look at someone like Northern Trust, who's our partner in custody, you don't get a more traditional organization than them, 150 years old, but they are very active and they are part of our network. So I think exciting space. We have to solve the trust problem. Back to you, Branson.
Thanks, Rahul. Yeah, so how about Glenn? Do you have any thoughts, and also the question on, how has a Ledger partnered with any of the local financial institutions here? A quick one, maybe. Yeah.
Right. So to answer the question from the audience, Ledger APAC just landed in Singapore about 4 months ago from Hong Kong. So we are slowly starting to develop a network with the banks, not just the large banks here in Singapore, but trustees, custodians, family offices, and so on and so forth. And of course, we have engaged a lot of them in their conversation. And one thing that I like to share is that one commonality is that they are actually building, from a technology perspective, when they require a platform to custody and to service these digital assets. They're looking at crypto and digital assets or tokenized assets or security tokens from an operation perspective, all the same. So they don't want to have 5 different workflow depending on how you define, different types of, these crypto assets. Of course, there is some regulatory implication, which I'm not an expert on, but at least from an operational perspective, this is what they're looking for. And obviously, the lower hanging fruit for us are not necessarily the larger banks today. There are a lot of POCs and RFIs that's going on in that space, but the real kind of use case that we are currently building are with the trustees and the family offices and the high net worth individuals, where they may decide to convert their traditional asset class into something digital, whether it's gold or whether it's some kind of exposure in real estate. So they are trying these little things out, and sometimes they use nanos and sometimes they use the institutional technology. But at the end of the day, they want to streamline everything, and that's how we'd like to help. With the trustees, custodians, and even the larger banks as well, we actually did a JV with Nomura, and the entity is called Komainu. So, we have a fully regulated custodian partner where they have the capability to create a sub-custodian partnership with the companies, where sometimes it will take larger institutions a few years to build out the capabilities of servicing these digital assets. And I would say the lower hanging fruit for them, if they want to enter this space really quickly, would be to find these partners to help them scale.
Got it. Thanks, Glenn, for your inputs. The next question I have is with regard to regulation. So I think, in fact, the audience have the same question. So essentially, how is it? How do you see it? Is it conducive? Is it keeping pace with the industry? And a bonus question from the audience: will we see Singapore as the #1 jurisdiction for security tokens with a global reach? Anyone want to take that on?
Can I take that on as a first thought? I think MAS has been extremely progressive as a regulator, and they started way earlier compared to most other jurisdictions in being able to clearly enunciate how they want to distinguish between various types of digital assets. And they were one of the earliest ones to clarify that any security, whether it is backed by any kind of technology, or in any form would be governed by SFA. And back in 2018, when we were looking at various jurisdictions and we were talking to MAS, they were actually the only ones. Pretty much everyone else was still grappling with the thought of how to regulate crypto, whereas MAS had launched much further ahead. That, along with PSA, which has been launched earlier this year, the RMO regime that has been enunciated much more clearly. I think all of these put together, it's very clear that the regulatory intention is to build an ecosystem that is ahead of its times comparatively, and they are placing themselves to be that hub of the financial hub for this new ecosystem. So I do think that there is a large role Singapore can play in providing direction to the world as to what kind of ecosystems can be developed, especially in the security side, where a large amount of efficiencies will necessarily be lost if every single participant starts to create their own little DLTs and their own little spaces. And that's why I think it's very critical that there is a bottom-up along with a top-down approach where both of them meet somewhere in the middle to be able to create a scalable infrastructure which all, and with an open architecture which all participants can join. So Singapore has the right mix of not being too large an economy and hence being able to play or create POCs, so to speak, that can be adopted by the rest of the world, as well as having a regulator that is very progressive. So I think we have the right conditions which can put Singapore on that spot, being that one-stop jurisdiction for STO. That's my thoughts.
Thanks, Tuina. I agree because they have been very, very helpful, to be honest. Any other panelists?
I'm going to chip in. Yes. I won't spend too much time on this. I think Singapore dances with the international beat. So everywhere, we want to regulate, right, for various reasons to take care of all the real and perceived risks. And I think if you look at what's going on from the regulatory perspective, and if you look at the level of sophistication of the products that are being invented, and although I say I hesitate to draw that distinction between the tokenized security and security tokens, but if we just look at it very generally, somehow I do feel that security tokens are a bit more sophisticated, more complex, which requires the regulator to spare more attention and to appreciate, as opposed to the tokenized securities, which the underlying thing is already securities, and you're just wrapping the technology around those securities. And if you ask me to make a guess, then I would say that chances are tokenized securities are going to move faster than security tokens. Thank you.
Thanks, Chia Ling. Yeah, I mean, you're right. I mean, we have seen interesting products because I've seen CDOs being prepackaged into some of these tokens and things like that, and there are a lot more interesting stuff happening in the DeFi space, if you may. Yeah, that will be an interesting development, I would say. Any other panelists would like to chime in?
Maybe just my short history in Singapore. I've been attending some of the webinars hosted by the MAS, and just from a general kind of perspective, as compared to some of the other jurisdictions where I see avoidance of bringing up some of these topics. I see, regardless of how difficult the rules are to be met by the participants, I can feel that at least the regulator in Singapore has some kind of, I think framework so that, people can kind of work towards. So from that perspective, I see, Singapore as definitely a hub and is building the right ecosystem to, involve more ecosystem players into the game.
Yeah, that's a very astute observation. Thanks, Glenn. Yeah, just a reminder to the audience, you can actually ask questions, and I see Alex here as well. Alex has been involved in quite a number of international organizations as well with regard to security tokens and digital asset space. To the final question, this is a general question. Any advice for the audience or companies looking to get involved in this space? And this question is from Joe, because they're trying to understand this. Is there a book to read, or should they speak to someone, or what should they do? Yeah. Who wants to take that on? I think this is a fairly interesting question.
Sure, I'll pick it up. You know, I think getting involved in this space is relatively difficult because there's not that much information out there that's as easily accessible as, you know, let's say, just even getting involved in traditional capital markets or the exchange ecosystem for OTC or derivatives. You know, something along those lines has vast amount of literature, books, everywhere you could find with immediacy. But the security token market is relatively hidden and still quite niche. You know, joining things like these webinars is obviously going to be very beneficial. I'm sure any of us are also willing to host some questions if you were open to, you know, sending an email off to any institution or platform or company that's involved in this space. Most are relatively open to discuss what's going on and you know, potentially how you can get involved. There are some books and pieces that are coming out now on security token literature for digital assets that can be quite useful. But I'd say, you know, probably the best way to go about it is to reach out to the individual companies that you might be interested in, start doing research, Google keywords on specific companies like Propine or Bondi Value or ECXX or Ledger, what Osborne Clark is doing. And there's also reports that are being released probably on a bi-weekly basis by different large big five consulting firms about security token market, compiling all the data that can be found at the moment and trying to put things together. But it's still relatively difficult. And I think that sourcing all of it at the same time is going to be a large undertaking. It's something definitely needs to be focused on for the market to grow is providing a strong database of you know, information that's easily accessible. So good luck.
Thanks. Thanks, Aslin. Anyone else? One piece of advice from everyone, maybe Charlie? Quick one piece.
Look for a good lawyer to help you navigate the rules.
Tuina?
I'll always say that if you cannot take the basics of crypto out of security tokens. So for you to really be able to appreciate this, it would be good for anyone to appreciate the basics of crypto and blockchain instead of just diving straight into security tokens, especially at this early stage. Of course, it depends on where you're coming from. So there are people who would just be like, okay, I just know capital markets and all I care about is the use case, which is fine as well. In which case, as Hassan said, the best way to know about security tokens development would be through the industry reports that are coming out rather than through any books. But for crypto and blockchain, I think there are several really good books. One really good and easy book to read, I will plug in here, is and it's written by a fellow Singaporean. I mean, he's in Singapore, Anthony Lewis. It's Basics of Bitcoin and Blockchain. At one point of time, I had made it a mandatory reading for anyone joining Propine to get up the curve. So, you know, like, I think those are the two ways to go up the curve on the knowledge.
Thanks, Tuina. Rahul?
Sure. My advice would be that companies are built by teams. And in the security token side, we need to know both the securities laws of, you know, who wants to buy, who wants to sell. So if you could have one founder focus on that aspect, who has the domain, the use case, and another or expert in the team look at the technology aspects. value is created when two domains intersect, right? There are lots of people who are, standalone great in technology or standalone good in capital markets. But if you could pull together a great team, then you can really change the world. So that's my first piece of advice. The second piece of advice is that today, the way we are all working, you can take your ideas to fruition very quickly. So go for it, jump into the fray, and I wish everyone the success. The second thing is all of us here are also happy to chat and discuss and have a coffee to help people, learn from whatever our learnings are. So it is a very friendly and close-knit community.
Great advice from Rahul. Glenn?
Yeah, I tend to think about, like, why do people care, right? So there are things that exist today, but why are we here to talk about this, right? So, I think sometimes it's better to kind of stop and think about that. And then we can also kind of think about what are the frictions that this market has, and what kind of technology or operational kind of efficiency would this bring to the table. So that way, then I think I tend to kind of find my way to think about what I need to read or what I need to think about next. So that's just one piece of advice.
Got it. Thanks, Glenn. Alex has also posted one of the links to security token offerings, and as well as Norbert, which is a podcast with Tuina. So I think there are a lot of resources out there that you can leverage on. In fact, to Rahul's point, you can also get in touch with some of the panelists here via LinkedIn or whichever means. I think we are more than happy to have a chat, and the ecosystem can only grow stronger with more interested parties and more contribution from everyone. Yeah, thank you guys. Yeah, so that wraps up our panel discussion. The next section is actually the RMO Consultation Paper. I'll hand over this session over to Nizam, who will take us through the consultation paper. Nizam.
Thanks very much, Benson, and good to meet the panel members and welcome everyone to this session. As you know, the MES has issued a consultation paper, and this is quite a technical and focused topic on capital requirements for RMOs. I think it's meant to be a more nuanced approach, so there's some relaxation of the requirements, there's some more risk calibration of the requirements. But before we do that, let me just share my screen. Okay, I hope everyone can see this. So this is just a recap of where we have been so far. So as a former regulator, this topic is something quite close to heart, really, because I had the pleasure of drafting some of the provisions of the SFA in my previous life, and especially in relation to markets and exchanges. And this is an area that has seen a lot of evolution over the years. Now, you remember this, this is quite a seminal consultation paper, which was in May 2018, where the MES actually broached the ideas of having 3 tiers for the RMO. Now, this is not yet in place. So in case you're wondering, how come there are no retail RMOs at this stage? Because technically, this hasn't yet been implemented. But in this model, the MES actually envisaged that for the first tier of the RMO tier 1, you can actually, the RMO can actually reach out to retail investors subject to certain restrictions, certain caps on numbers within Singapore, and also the maximum investment limit. So in effect, you could raise $4 million from about 200 Singapore investors under that proposal. And then tier 2 is calibrated against the current regime broadly. And a lot of RMOs actually fall within this bucket in practice, where the RMO actually targets accredited investors or institutional investors. And RMO tier 3 is meant for RMOs targeting financial institutions, other fund managers, or even banks. So there's a calibration of capital requirements for RMOs, tier 1 and 2, $500,000. So that's the magic figure that we're going to talk about today. For tier 3 is $50,000. Now, approved exchanges, those are the big boys, right? So in Singapore, there are only 4 approved exchanges: SGX equities trading, SGX derivatives trading, what used to be the futures trading side of SGX, the Intercontinental Exchange and APEC exchanges. So approved exchanges are deemed to be systemically significant. So hence the very high, in relative terms, capital requirement. That's where the regime is, or that was proposed. So this is another representation of the different tiers. So you can see that there's a tiered a set of regulatory requirements, approved exchanges, systemically significant, therefore, a lot of requirements, tier 1, tier 2, tier 3. Now let's get to the MES consultation paper. So we actually want to hear from you. So one of the objectives of this exercise is to take you through some of these changes and to also get a sense from everybody as to what the reaction would be. So that is part of the exercise of the consultation paper. So I think the Blockchain Association will be distilling some of the comments that we receive, whether from the panel members or from the audience, into a set of submissions to the MES. Okay, so let's go ahead with this. Now, the key point here is that whilst yes, RMOs are supposed to function in a fair, orderly, and transparent manner, like securities markets. So this is not new. Securities laws have been in place for a long, long time. In the US since 1933, 1934. In Singapore, the SIA has been around for some time before it was repealed and replaced by the SFA. So fundamentally, securities laws still apply, even so regulations are technology agnostic. Now, in the context of the markets, the MES has always looked upon markets as furthering the objectives of fair and transparent market. And the key risk that the MES has articulated is operational risks. So the view that was taken was that, look, the MES actually said that RMOs are not meant to be offered to retail. And I think there's a bit of a disconnect with the earlier consultation paper in 2018, where clearly there was an intention to allow RMOs to reach out to retail investors. So the real risk is that if an RMO winds down, so the RMO doesn't hold the customer assets. So the assumption is that the assets will be held by a custodian, an independent custodian, whether it's someone like Propine or on-chain custodian or some of the other custodians that might be coming up. And therefore, the key risk is, when you wind down, will you be able to at least sustain for 3 months as the people who trade on your platform move across to another RMO? So that was the first significant point that the MES has raised. I just want to get a sense from the panel members. First of all, what they think about the fact that now the MES is not meant for retail. Second, on the issue of operational risks, is that the key risk for an RMO? And any other thoughts about the key requirements, 3 months sustainability? So any thoughts from any of the panel members?
Yeah, Brenton here. So maybe I can share my thoughts. I think obviously the current regime, RMO, does not allow us or forbids us from dealing with the individuals. So from that respect, I think the risk is much lower. Obviously, 3 months is enough for us to get the clients to switch over to another exchange. I think that's I would say it depends, right? Because while we are not able to deal with the retail clients, I think there may be a significant amount of tokens involved. And in that respect, I think 3 months may be a little bit short. Yeah, that's my view, yeah.
Go ahead, Rahul.
Nizam, if I may say this, the amount of capital that one puts, I'm saying in a general manner, it is two forces, right? One is you want it to be low so that, you don't have to set aside too much money. But at other times you want it to be high so that your participants have confidence that you will be around. If I tell you that, the minimum I need to have is very low, then it actually reduces. So it's important to get it just right. I think the second part is that our RMOs so homogeneous in their business models that they can easily be transported, right? If yes, then maybe 3 months is okay. But if the RMOs are not that uniform or homogeneous in technology, in business system, that they cannot be ported, then perhaps it needs to be a little higher. Lastly, if we look at the capital requirements compared to risk-taking businesses, because RMOs are not and should not take risk, this is not a lot of capital that is being put. The fourth and last point is that sometimes, you make revenue and you have expenses. So your burn is the difference between the two. And, if you're, so do we look at only costs or costs, revenues, less costs? So there are some 3 or 4 things that I want to speak, and I think we'll just go into specifics very soon. So let me pause there and, hand it back to you, Nizam.
Thanks, Rahul and Branson. I think coming from the RMOs, those are quite germane points. So your argument seems to be that, first of all, 3 months may not be long enough, particularly in areas where you can't find an equivalent platform that trades equivalent products. I think that was Rahul's point that was made earlier. Okay, so just a reminder, the current benchmark is actually pegged at either 18% of annual operating revenue or 50% of annual operating costs of $500,000. So the MES actually now proposes that because of liquidity needs, because of the operational risk of RMOs, therefore there's a need to ensure liquidity. So the proposal is that 3 months, as we discussed, so enough cash to continue for 3 months. And the proposal actually is that the RMO must hold 25% of their annual operating costs in cash or cash equivalent. So the assumption that these broadly falls within 3 months of operating costs. So any thoughts on this? Rahul, maybe you'd like to kick off first since you were, this flows from the last point that you made.
I think absolutely, people need to have cash, because balance sheet equity and cash, as all of us know, is 2 entirely different things. So I think people do need to have, and banks have to do that. It's called HQLA, high quality liquid assets, right? You're always looking for solvency to be important. So I think it's a step in the right direction.
Okay. Any of the other panel members that who would like to comment on this? Well,
yeah.
If you look at the, sorry, if you look
go
at
ahead.
the way they have, so if you look at what they've really done is they've taken the previous requirement of $500,000, 50% annual operating costs. They've just divided into 2 components, pushing half of it into the liquidity part and the other half remains under your solvency part. And all they're saying is that whatever we had proposed earlier, half of that should be fairly liquid to be able to ensure that there is 3 months of operational cash flow. So it isn't an additional requirement. And I would agree with Rahul that it is absolutely essential for a market operator to be able to have that wind down capital, which ensures and gives comfort to people that the market operator will be able to support them and they will not suddenly leave them high and dry for them having put their eggs in that basket. But I do agree that 3 months might be too small. But then there is this whole chicken and egg. If we say, oh, we need like 6 months, then you will need to put aside that much more capital. So where do you draw that line? I think somewhere a certain amount of certain insurance policies can come and help in that as well. So a PII kind of insurance policy to a certain extent can help alleviate some concerns, so that in case people who are working with you get really hurt by your stopping of operations, they can potentially have a recourse to a PII kind of a insurance. But it's a very I'm just talking of like a completely out of the box solution as to like how you can potentially bridge the concerns that the clients may have.
Thanks, Tina. Branson, you wanted to say something just now?
Yeah, I agree with Tuina and Rahul. Essentially, I think this will give a lot more participants the comfort that actually, we are serious about, securing the reputation of the RMOs. So I think it's a step in the right direction. At the same time, is the liquidity set aside enough for that 3 months? I think that's again debatable, right? Yeah, so I think that's the main thing. But the good thing is in percentage form, right? So as you scale, there's also the you got to set aside higher in proportion to your operating costs or your operation. So I think that's good in a way. Yeah.
Thanks, Branson. Let me move on to the next. Sorry, is there a question 2? I think we missed question 2. But I think this was the point that Tuhina made, that there was a trade-off. So the good thing is that the MAS actually moved or calibrated downwards the requirement for solvency, because now the key risks, as the MAS has identified, is operational risk and not so much solvency. Well, it's still relevant, but not. But they have balanced out. So the proposal is now the RMO has to hold the higher of either 25% of operating costs or $250,000. So that was a proposal by the MAS. That was question 2. So any thoughts by the panel on that? Tuhina, do you want to kick off first? Because that was flew on from the point that you made earlier on as well.
Sure. There's not much to say about that. It's just that they've recalibrated it downwards because they've just simply said that the liquid assets will have to be higher. So they kind of like dovetail each other. It's just division of the earlier thing into highly liquid assets versus not so liquid assets. But at a later stage, I would want to talk about the first point you had raised, which we did not discuss, which is about retail participation, maybe at a later time.
Okay, why don't we get into that actually? Because I think this is quite a very logical consequence of the first, the second proposal. Sorry, the first proposal. But let's get to the issue of retail. Your thoughts on that? Is it should RMOs get into the retail space?
So this is again a question that will require a more systemic approach. It is not just about RMOs. So if MAS requires RMOs to work with, say, custodians like ourselves, and they allow retail participation there, then they'll have to make sure that other participants who are working with them, like Propine, will also need to be able to service retail. I think like the original intention with which they had started off was, I think, good, because what is the point of, I look at it as a two-step process with a final vision where you have to be able to democratize these capital markets. And when we talk of DLTs and its impact on capital market, I think the first low-hanging fruit is really private markets and not public markets. Public markets are fairly efficient, and the state at which our current technology is, I don't think it's going to make a very large dent in the public equity space or a public bond space. I think there is a much, bonds, yes, it can. Rahul is there to talk about that, but definitely not public equity space. So I think private markets is where the low-hanging fruit is. That's also the space which has made which has created much larger value compared to public equities in the last 10 to 12 years. And so it is about time that we can use the new technology to be able to democratize the space, and hence participation in this space by retail investors is absolutely important. You can start off that in these limited ways in which MAS was targeting it. So taking that off completely from the table, I think is a bit regressive. I would definitely love to see retail participation coming to. And we've seen other jurisdictions come forth on that. We've seen that in Korea, we've seen that in Canada. So we have examples of how other jurisdictions are trying to calibrate that introduction.
I see some of the other panel members nodding their heads in agreement. Anyone else like to chime in on retail participation? Haslin?
Yeah, I'd love to chime in. You know, I think what we've seen in the space has been an approach towards private markets and largely only focused on accredited investors thus far. And there's only been a few jurisdictions that have really taken a lead to try to also access the retail market. So, you know, Thailand has opened up some of its tokenized bonds to retail investors. Even in Singapore, they've given some letters of no action to different types of tokenized assets. And I think what it all boils down to is that it's all about the risk involved for the investors. So if you are giving a very low risk asset that has been tokenized, a tokenized security, you know, it is potentially much more beneficial to open it up to those investors who might not have had access to that prior. You know, it's harking back to what Tuhina mentioned about democratization. You're applying the benefits of blockchain and DLT, the decentralized aspect, the fractionalization aspect, and you're making that applicable and useful for retail who can now get engaged with types of investments they might not have been able to access previously. So, you know, there are even particular markets that aren't regulated that retail can still partake in. So tokenized gold, tokenized carbon credits, these types of things are unregulated markets that retail can still get involved in. But when you look at, you know, even the public markets, as Tuhina mentioned as well, let's say share stock in Berkshire Hathaway, you know, a single investor who might not have enough capital can't even purchase one share of that in the public markets. You take fractionalization of public markets in the future, you know, not sure how long that's going to take, but eventually getting to that point where you can provide access to even public stocks that are inaccessible to lower retail type of clientele, you know, you're impacting the larger base of investors that can scale these markets, broaden this ecosystem, and provide investments to underserved, underprivileged, you know, demographics within every region. So I think that's one of the benefits of security tokens long-term, this technology, and really what we're trying to enable in the long tail approach.
Thanks, excellent points, Haslin. I mean, the whole idea of, I mean, one of the key use cases of tokenized securities is that you allow fractional interest participation, and that's meant for retail, right? So if you remove retail from that equation, you're really removing one essential use case of the blockchain. I now want to move on to the third point, and that's the draft notice in the annex to the consultation paper. We're not going to go through all the requirements. That's just a very brief summary. So first of all, I mean, and it ties into the points that were made earlier. So the RMO cannot cause its liquid assets to fall below the liquidity requirements. And also the solvency requirement, that's paragraph 4. And the key obligation is that you must let the MAS know if either para 3 or para 4, you know, below 120%. Sorry, let me rephrase that. So if your capital falls below 120% of the requirements as set out in para 3 or para 4, you must let the MAS know. And there is one requirement which might seem a little bit onerous, and that you must calculate your liquid assets and eligible capital for each business day no later than T+1 on the next business day. You know, I'm going to pause here because I think this might seem a little bit onerous, but I'd like to hear from the RMOs in particular on this. Is this something doable?
Well, I guess that's me, Nizam. Right? I think it is doable, right? Some of us on this panel have worked in financial markets. So can we calculate risk and capital on a daily basis? Absolutely, we can. But operationally, is it required and is it cumbersome, right? Because the nature of the business is such that your capital doesn't change day by day needed, because we're not in a risk business. So I think if it can be made less frequent, then it will be certainly helpful. Because if there is a requirement that we have to calculate it each day, then we'll have to evidence that calculation, that we've tracked it, that it's there. We'll have to then see what changes day by day. So there can also be some metrics that if you're, for example, above 200% of your requirement, then you need not do it on a day by day. Or because the clause 2.1A and 2.1B put the onus on the RMO to make sure that he has adequate capital. Now, when do they measure it? I just think every day may be a little bit of a overkill, particularly in a scenario where most RMOs will have capital well in excess of what is the minimum threshold.
Thank you, Rahul. Branston, your thoughts?
Yeah, I mean, at first glance, I do feel that 2.1A and A and B versus C is somewhat interesting, because if I were an RMO, and we are, potentially we will just go for C, right? Essentially, what we are saying is that you must conform to the fact that you have 120% of the requirements rather than 100%, because if you fall below 120%, you have to notify MES anyway. So by default, we would have to comply with 2.1C, right? So that's my first thought. And the second thing I want to say is that, just to echo what Rahul has mentioned, it's a little bit, I would say, restrictive in that sense. I'm not sure whether that's the right word, because for us to calculate it, no later than the T+1, essentially means that, we have to be always on our toes. Maybe that's what that's the essence of what MES is trying to do. But at the same time, operationally, I think there are a lot more things that we have to focus on. Not just the calculation of the liquid assets and the eligible capital, I would say. Yeah. So if we can seek some form of relaxation in some way, I think that would be helpful, I would say. Yeah.
So are you, okay, I think Rahul raised a slightly separate point. I think his point was that there should not be an obligation to calculate it on a daily basis. So assuming, let's say, if you were to counter-propose, calculate on, let's say, once on a weekly basis, do you also, is that okay? And do you do it on, and the other point relates to how, how quickly or how promptly you calculate that. Is it T+1 or T+2? So,
yeah, I mean that the frequency of it, to me, to be honest, is up for discussion, because at the end of the day, if you look at the components that go into the liquidity requirement or the solvency requirement, it's very prescriptive, right? So there's certain items that you can consider, certain items that you cannot consider as liquidity or capital requirements. So I think that part, then we would need to get the accountants involved as well. So I would say it's additional work for the RMOs. Yeah.
I think you need a RegTech solution, to be honest.
Can I chime in here?
So to the audience, Emily wants to do a RegTech solution. This is one use case. We've not heard anything from the audience, so if you have any questions, please let us know.
Has something to say.
Can I chime in here, Nisa?
Oh, sure, Tuhina, sorry.
So I think Rahul and Branson have been extremely sweet in the way they have put their thoughts on this point. To be very blunt, I think it is very onerous, honestly, to do this on a daily basis. Like Rahul said, it is possible, but it's expensive. And most of us, speaking for myself, for example, this is accounting is not something that I would put a full person doing that work on a daily basis, right? We outsource these type of activities, which means that, and also if you look at the way these numbers are calculated, it doesn't really change on a day-to-day basis. And then looking at the business model, I would say that doing this and reporting it on a monthly or in a worst case scenario on a fortnightly basis is probably more than enough. I think monthly is a very good frequency, with an expectation that you can predict what your burn is going forward, what your capital is. You already have that idea. So you can probably predict that given my history, given my expectation of burn, this is what my next month is going to look like. So unless that number falls dangerously toward 120%, I think you can do this on a monthly basis. And then when it starts to go to that 120% on your expected this basis, or if you've had a very large capex that you hadn't expected, or a large expense, only then you should start doing this on a much more frequent basis, like event-based versus an expected predicted basis as well. So that can bring down the frequency.
So essentially, Tuhina, you are suggesting that leave it to the RMO to risk manage by themselves, whether it's a weekly or monthly basis.
You definitely they anyway have to risk manage, but the reporting can be on a monthly basis, unless you on a prediction basis that my next month is going to be something like 140 or 150%, versus if it is like 2000%, then you don't need to do it on a daily basis.
I don't think that this requirement talks about reporting, though. It's just an obligation to calculate on a daily basis, and by T+1.
Agreed.
So,
it's not reporting, but if you're calculating it on a daily basis, then you need to be able to show it on an auditable basis that you've actually done that activity. So I think if we can do that on a monthly basis, that should be enough, unless your number is getting closer to like 150, 160%, then you're like, okay, I could fall closer to that number.
Thanks, Tuhina. Rahul, do you want to add on this?
Yeah, I think, I've said my thing, but let me, sort of explain why sometimes daily also makes sense, right? If you see, RMOs are allowed to have debentures contributing towards their capital. Now, bonds can move a lot every day. So if you have that money parked in debentures, then you should calculate the mark to market on a daily basis, right? The other way to look at it, I'm just arguing the other side of why, potentially you needed to do it daily, is that if you have 3 months of runway and you calculate it once a month and you found out that you're below, then you have only 2 months of runway left. So it all goes down to, I think, the balance between having adequate capital and ensuring it. It's the board's responsibility of the RMO that they never run short of capital, and it cannot be, delegated away. If we can make it operationally easier and let the board decide adequate methods based on their own circumstances to ensure 2.1 A, B, and C are all complied with, that may be an outcome that ensures that all that we have said, both pros, cons, are taken care of.
Thanks, Rahul. And just on the point of what constitutes the components of cash or cash equivalents, and the other instruments to meet the liquidity requirements. So the notice actually sets this out: cash equivalents, government debentures, certificates of deposits, money market funds. So that's one set of so these are the eligible liquidity components. And in terms of solvency requirements, so here are the stipulations. So eligible capital means either base capital, paid up irredeemable cumulative preference shares, your paid up redeemable preference share capital, or revaluation reserves, or other reserves. So which is broadly similar to the risk-based capital requirements or the capital requirements for other FIs. I don't think anybody's going to quarrel with these components, but if you have any comments, please let me know. Okay. I know it has been quite a technical consultation paper, and that's probably why the audience is perhaps shy to raise any points. But any final comments or thoughts from the panel members before we wrap up? Anyone? Okay.
I'm good, Nizam.
If not, I'll hand you back over to Branson. So thanks very much.
Yeah, thanks, Nizam, for taking us through the consultation paper. So what we will do next is to consolidate all the responses, and we will, give the feedback to MES. That's all we have for today. Thank you so much for your time, everyone who has contributed in any way or even being present and asking questions. We could not have done this without you. So thank you very much to the panelists as well as Nizam, and have a great day ahead. Thank you so much, everyone. Thank you.
Thank you.
Thank you.
Thank you. See you.